Good day, everybody. Ron Greenke here again. Going to cover lesson 3 of our 3-lesson series of how to improve your investing success. These are the 3 lessons we were working on. The first one was what to buy, when to buy, a very key element in your investing process. Lesson 2 was you make money by selling. We're pointing out that to be successful, you need to sell something to gain a profit. And there are a number of ways that was demonstrated in lesson 2. Lesson 3 is the trade plan. Just do it. In this lesson, I want to show you that to make progress, you don't contemplate. You need to look at the opportunity and just go and do it, because you learn by trying, and I think the example I'm going to show will demonstrate that it's very possible to be successful in investing in this process where Wall Street Winning shows you what to buy, when to buy, basically what to sell. And so now the next step is to actually do it. So let's go look at a trade plan that generates a plan for a result that we're satisfied with. So after finding the right stock, knowing when to invest, and having the best options to sell available, I say it's time to prepare the trade and execute it. We can lead a horse to water, but we cannot make him drink. So why use options? We're selling call and put options because they can improve your result. The premium from selling can increase your return. The premium from selling reduces your risk. And the premium you get from selling is a way to generate monthly income. You plan what you're satisfied with on your holdings. It's all up to you. Here's Netflix. It's an M. Remember, we talked about the rating, so it's a moderate. It's in these indexes, which is good, followed by lots of big companies. A lot of big institutional firms are investing in Netflix. It's a 5 money bag. Past success rating has been great. It says we can generate about $1,000 in 22 days, and of note, it is in my hot list. So I got notice of this also in my email as a buy opportunity for April 25th. So this is on Monday the 25th. Here is the buy issued. So let's take a look at more detail. Here's the buy right here. Here's the symbol here's the last price that it came at, right? And it was a moderate. Okay, I said it was a moderate. There it is, right there. A little bit about it. The target annual return, okay, is 44%. That's the APR. If we follow the signals, get a 44% return. And in this trade, we're looking at about $1,000 on a $10,000 investment. So a significant opportunity in front of us right now. So let's take a fundamental page, and you'll see here's where the buy was at, and then these are the sell points, 103 and 87.27. So that's what that longer term the longer term option is based on. So we're going to go out further here on number of days to 513, and you'll notice the strike prices are close to where we're selling it on the upside and on the downside. So these are options suggested for Netflix, do a covered call, and a put. So let's set the trade up and see what the result is. You can use Excel, very easy to do. Just build yourself this table. Here's the equity, the date of the sale, which will be Monday. I'm going to buy the stock. I'm going to buy 100 shares, pay $95.90 for it, so I have a negative in my account. That's what it cost me, plus commissions. I'm leaving commissions out to not confuse everything. Everybody has a different commission rate. I could throw in here an assumption of maybe $14 round trip. Yours might be less or more. So this way you can factor that in. So if I buy 100 shares, I go negative 9,500 in my account. If I turn around and sell to open, I'm selling to open the call. Sell one contract for Friday, strike of 96. I get $1.90. That's what they're paying, $1.90. So that reduces my basis by that amount. And if I get called, so I'm planning to sell the stock at 96, I get my money back right here. And I've made $200 or I've made 2% in 6 days. Okay, 2% in 6 days. So, and I'm doing this example based on a $10,000 investment. So you can factor that. You can scale that to what you're looking at. But $10,000 gets me $200 in 6 days. Monday, I'm configuring today, which is Sunday. I'm adding the extra day just for rounding. Okay, so we have this trade then is set up. This would be our return if we're called. In other words, if the stock is called on Friday, at the end of Friday, automatically, if I put on this trade, I can go on vacation. The stock is above 96. I'll have this money back in my account. I get the 190 here. I get this immediately. I could withdraw that and use it if I wanted to. So for example, if you did a $50,000 investment, you'd multiply this by 5. So this would be almost $1,000 trade return, okay, for the week. And on Friday, automatically, if the stock is above $96, I'll get assigned. My 100 shares will be traded automatically by the brokerage firm. It happens automatically. There's nothing you have to do. You'll have the money back in your account on Monday, following that Friday for a new investment. What about the put? Well, kind of same thing. I'm going to sell to open. A put, 1, expires on Friday. If the strike is 95, I'm going to get $1.56 for that. So automatically I get $156 in my account. And if I did this in a retirement account, I would have to have $9,500 available to buy if I was assigned this put. In a margin account, if I have enough margin, I don't need anything. I'm going to get $156 for free if I'm doing this on margin and I'm not assigned. So here's, money from nothing, is what I call it. There used to be a song like that, money from nothing. It's possible. If the stock is above 95, on Friday the 29th, we made $156, and all we had to do was put up our intention to buy. Here's a combined, okay? A combined covered call and put. I like to do this a lot because here's what I'm doing. I'm going to buy the stock, buy 100 shares at $95.90. I'm going to sell the 96 call. I get $1.90. I'm going to sell a 95 put. Okay, so I've kind of got a channel here. The stock is trading between the two. If it goes up, I'm called out, my put expires. If it goes down, my call expires and my put may be assigned. So I might buy some more, but I'm not buying it at $95.90, I'm buying it at 95, 90 cents less. So basically I'm working my way into this position. Right now, if everything goes as planned, the call will expire, the call will be assigned, the put will expire, and I have made $356 in 6 days on basically this $10,000 investment up here. I have to have money set aside if I'm assigned on the put. So if it's in a retirement account, you divide this by 2. In a margin account, you really made 3.7% on $10,000 because you did not have to use any of your own capital to put on this trade. All you had to put on was margin and your intent to make the investment. So that's a win-win. So this is the trade. So now all you do is, Monday morning, 9:30 when the market opens, you look at where Netflix is, and you put in your bid to buy the call or to buy the stock and sell the call, sell the put, execute the trades, and then you can go on vacation. Now, what if you don't have the time to do this stock and option selection and trade plan preparation? Then I suggest look at Done For You. Done For You is a opportunity that's provided on the Wall Street Winning webpage under your subscription, where you can look at selections that are being done and trades that are being made and that are being tracked to show you that you can do this. So I suggest, if you don't have the time, just go do it based on what's being provided. Here's the example. Here's a Done For You weekly trade opportunities. So here we have the summary, and the opportunity is identified on 4/24, and lo and behold, look at, here's our Netflix, the exact opportunity we just covered. It's being presented as a viable opportunity on this is Sunday the 24th. So it's presented on Sunday to be made, so you're available to look at it for Monday morning. At the top here, I'm showing the summary of the tracking. We've had a win rate of 100%. There's 21 out of 21 trades that were completed. The summary is provided below. We'll scan through that. You gain $12,000, about 25% in 72 days on a $50,000 investment. So if you annualize that, that's over 100%. In other words, you're going to double your money in 12 months by doing these weekly, bi-weekly, or monthly trades. So if you had a $100,000 investment account, you could generate income of about $10,000 a month. Pretty nice. $10,000 a month. Anybody should be able to accept that as a good return. So here we have our Netflix. We just covered that. Here's the other opportunity, VLO, which is a oil service company. Here it suggests you buy 200 shares. So it's right around 10,000. Options come in units of 100 shares per contract. So here I could use 100. That's close to 10,000. Here I took 200 to generate about a $12,000 investment. I have to round everything up to 200 shares, which is okay. Some are going to be higher, some lower. You average it out over time, and you'll get to close to your $10,000 per position. Plus, it reduces the risk. Some people like to use 20,000. That's fine. We would just double these numbers then. So here we have 200 shares, 61.24. You're selling the 61 calls, a little bit in the money. And selling 2 contracts and selling 2 puts at $60.50. This is what was identified, okay, in the buy opportunity at Wall Street Winning. These are the two options that were in green, okay, on the income option panel when we selected options. So they're provided here. Here's the premium. And then here's the return. The plan is the stock will be called on Friday the 29th. You get 200 shares will be sold at $61. Basically get your money back. You made $332 in 6 days, okay, which is 2.71%. Well, a little bit less than what we did up here. People say, well, why wouldn't I do more of this? Well, you want to diversify. We want to be diversified. We want to be in different sectors, in different areas. We don't want to put all our money in, all our eggs in one basket. The more baskets we have, the less risk we have of, the whole thing going to hell in a handbasket, okay? If Netflix goes down and this one executes, we were successful here. This one might go down a little bit. So we may down the road have less than 3.71% return. So we don't know. So we want to start looking at, these are the actual percentages now. This is getting $356 in 6 days. And this is, $332 in 6 days. Okay? So this is real money. This is not fictitious and hope you might get it. We got this because we made these option trades right here. Okay? There's our return right there. Add that together. 601, that's $380. It's more than this because we gave up, right? We're selling it in the money. We gave up 24 cents right here. So really out of this 117, you subtract 24 cents. That's the premium we got for selling these two contracts on this call. So you can see we are making the money on the option. Our return is coming from basically that value right here. That's where we're making our return. Okay? We don't have to wait for the stock to go up. If it goes up, we're called out, and our $356, it was already in the bank. Okay? We didn't have to wait for it. Your option premiums are available immediately. Okay? As soon as you do these two trades, okay, this $346 basically is in your account, and you can even withdraw it. You can use it however you want. So that's the beauty of the option trade. You get your return up front. All you have to do now is wait for this cycle to complete, and your assets are available for basically your asset is your 9,600, right? It's this number right here. That's your asset you're waiting to get back. This here you can do with whatever. Okay? All we're doing is saying, give me my money back, okay? In the meantime, I'll take this $300 as my gain basically for the week and do whatever with it I want. Now let's look at some let's look at some past trades. Every week, 2 opportunities are posted. Here there's 2 trades open from the previous week, and here is the identified trade for the 25th. So what happened here is this investment was made, a call was sold at 108, a put at 105, the call expired and the put was assigned. Okay, so you had to buy 100 shares at the strike price right here, so we bought another 100 shares. You bought the first 100 here, sold a put, bought another 100, so now we're at an investment of about 21.8. And the suggestion is to sell 2 contracts now and go to a strike of 106. Okay, well, you say it's below what I bought it at. I bought it at 113, but look at what we did. We sold the first call at 108. Okay, so we got our difference. We got $5 in this premium we got back for protection. Stock went down. Okay, it's below 106 right now. It's below 105 because we got a sign. We can sell a 106 call on all 200 shares right now, get 285. And now have the stock called at 106, even though we bought it way up here, $7 higher. We're not taking a loss. We're having a significant gain. Okay, on $1,200. We're going out now another week, so it'll be 13 days for this to complete at 106. We're getting 21.20 back, so our gain is going to be 11%. In 13 days. So again, the key is this trades are open. This one we got our call expired, our put was assigned. Okay, we have another one on EXE, same kind of case. This was out a little bit further in time, where we got assigned the stock, and I think there's an error in this date. That should be 4/22. There's an error in that date. That should be 4/22. Sorry about that. To make that correction next cycle. So here, again, there was an assignment. The call expired and the put was assigned. And plan to sell now here 2 contracts at a strike of 108. You get $4.30. If we get our money back at 108, that's 12% in 13 days. Again, so these 2 trades are still in process. Nothing to worry about. We now own 200 shares of each. We're not selling any puts. We basically made a decision up front to invest half our value. So this is saying, we're going to limit ourselves to 20,000 max in any position. We started out at 10, now we're at 20 in each one. So now we're just selling calls on the positions we own. And we like to get called out. If we don't get called out next week at 108, we just repeat this process for the next week and sell another call at 108. Same up here. We'll sell another call at 106 or 105. And we can do that because we have banked a reserve here of $1,200. We banked a reserve of $1,300. So our percent might go down a little bit, but it's still well within a significant opportunity for the period of time. If you can generate 3% a month by doing this over and over, that is great success. Let's look at some other past trades completed. Okay. So here's a recent one, just completed on Friday. Happened 2 cycles, right? The first cycle we bought 200, sold a call. That call expired and the put expired. So we turned around and sold another call and sold another put, right? Because the call expired and we don't own anymore. We said we're going to limit ourselves to 20,000 while we have money left. So here we sold again, just kind of repeated the same trade. These are the premiums we got. And lo and behold, the stock was above $60.50 on Friday the 22nd. So it got assigned, got all the money back. This is the gain, 3%, 3.7% in 13 days. So again, in 13 days, multiply that by 2 for a month. You're at 6-7% a month. Multiply that by 12. That's unbelievable, okay? You say, this can't be done. Well, I'm here to say it is being done, okay? Let's look at the next one. Qualcomm. Qualcomm went through 1, 2, 3, 4, 5, had about 6 cycles here, okay? We started out the same way. Call expired, put was assigned, okay? So now, since we bought the extra 200 here, okay, we've committed to our 20,000 total, and now we're selling calls. So every week we're selling calls. We're selling calls at 52, 52. Sold a call at 51. Remember, the key is we don't want to lose money. And if the stock starts going down, we're going to start lowering our strike price on the call to eventually break even, get out, or even come out with a positive return. So this cycle here, since the stock was going down, remember we only got 17 cents here. So we went down 1 strike, got 71 cents. On the 11th, decided, okay, the 11th was on, since this was a 15 call, the decision was, okay, it's deteriorating faster than we'd like. We buy the call back, close the call. Okay, so we're buying the call back. It's a negative. We can buy it back. We got 71 cents for it. We bought it back for 35. We made 36 cents, right? Sold here, bought it back here. So we actually made money. And we turned around and sold a $50 call, right? Sold on that same day, 4/11, saying, okay, we want to get ahead of the game. If this thing is going down, let's protect ourselves. So we went down to a strike of 50, got $1.95. Boy, that's a nice premium. That's almost $2, right? So that's like selling at 52. That's like selling at what I bought it at, right here. So every other premium I got then is going to be profit. So I'm trying to exit this position in a positive sense, in a positive return. And lo and behold, on the 22nd, the stock was trading, I believe it was trading at about $50.40. So it was just above this strike. Okay, so the choice of 50 was the excellent, right on the dime. Got the $50 for it, got our money back, made $754, 3.6% in 41 days. Okay, so here's an example where we had to go 41 days to complete the cycle. Most of them complete in a week to 2 weeks. So this was 4 times as long, but we still made 3.6%. Now if you do that calculation, if you get out your little calculator, you take that and say, okay, how much did I make in a month, okay? I take 3.62, divide that by 41 days, okay, divide that by 41 days, multiply by 30. This results in about a 2.6% return in 30 days. So again, 2.5% a month is how much a year, okay? 2.5 times 12 is 30% a year, okay? Is 30% a year acceptable in your book? Yes or no? Well, it's acceptable in my book, okay? I shoot for 25. If I can average 25%, okay, that allows me to have even negative returns, okay? If I can have them all positive, and even though they may be small positive, it's better than having negatives, but I'm suggesting that over time, when you start averaging these out based on the number of days, you can do significantly well. Okay, so these are trades. Remember, these are completed. This is money. And we repeated the thing a month later on April 4th. This became a buy opportunity again. Here we made another 3%. Okay, so we're in and out of this stock. We're not just holding it. We're in and out, and we're making significant returns in short periods of time. There's no problem, you know, being in and out. That's, you see, we're using, you know, put this on your hot list. When this guy says buy, we buy, sell a call, sell a put, and wait a week. Take 3% to the bank. So the record, TQQQ, this one here, this is the triple Q index. Okay, this is the NASDAQ index. Again, made 5% in 6 days. Took a very conservative trade here. Okay, buy at 92.50, sell a 92 call and a 91 put. Okay, so it got called out, and you made this is in the bank. Stock didn't have to go up to $93 to be successful. It's to stay where it was, and we made a significant gain. So the key is we want to do this over and over, and you just need to do it. The trick is get the opportunities and just go ahead and do it, and do multiples. Do like the suggestion, $10,000 investment, do a put, commit another 10, and execute it and wait for it to happen, and go pick, you know, a number of them, and over time you will start building a list. You'll start building those that are successful. You'll repeat them like I did on Boeing and Trip. They'll come up again. Nike probably will come up pretty soon. Cisco comes up often. Intel comes up often. These are big companies, successful, going to be around, not going broke. Reduced risk on the, you know, your risk on the fundamentals is low, but you can repeat the process over and over, and that's the key to success. You just do it, and you do it over and over. So I hope this helps. Thank you, and happy investing.